Hey guys, welcome back to Trade Options Like a Pro by Sensible. In this video, we will address what is probably the most important question you will face as an options trader. This is when you have a view that the market is going up or down, you have to make a choice whether you should buy a call, sell a call, buy a put or sell a put. The second important question is, given that you have decided to buy or sell a call or a put, which strike do you choose? Let's try to answer these questions in this video. Let's start with an example. Tata Motors is trading at 400 rupees. There are 30 days left for expiry. Let's say that you somehow know Tata Motors is going to go to 450 tomorrow. And of course, in a real world scenario, there's no way you or I would know where Tata Motors is headed tomorrow. I mean, if we did, we'll be in a large yacht off the coast of France filled with, let's just say something which yachts are normally filled with. So anyway, what call should you buy if you believe that Tata Motors is going to 450 tomorrow, which is roughly 12%? These are the prices of options of various strikes. As you can see, the lower strike calls are pretty expensive because they are very likely to make money, and the higher strike calls are fairly cheap. In fact, they are very cheap because they are less likely to hit. So what we will do is we'll use a Black-Scholes calculator to arrive at the prices of these options when the stock hits 450 tomorrow. Let's start with the 390 call. A 390 call jumped to 60 rupees. A 400 call jumped to 51 rupees. A 420 call jumped to 33. A 440 call is now worth 18 rupees. A 450 call, which was originally worth 60 paise, is now at 13 rupees. A 460 call, which is worth 30 paise, is now at 8 rupees. Profit from each option in this case is 43 bucks for a single option of 390. A 39 buck profit for 400 call. 29 rupee per option for the 420 call. 17 for 440. 12 for 450. And 7.7 rupees for the 460 call. Now it's pretty obvious that the lowest strike call gives you the highest profit per option. However, it took 17 rupees to make that 43 rupees. The trouble with looking at just option profit per lot or profit per option is that it does not take the same amount of investment in each of these options. So to make 43 bucks out of 390, you had to put in 17, whereas to make 7 rupees out of 460 call, you just had to give 30 paise. So the right metric to compare which option is the best is actually the return on investment. So let's look at the ROI for each of these options. Wow, that's a 2.5 times ROI for the 390 call, 3.3 times for the 400 call, 7.3 for the 420 call, 13.4 for the 440 call, a 21x return for 450 call, and a phenomenal 26x return for the 460 call. So that's fairly interesting because your cheaper options hit like crazy when the stock gave you a big move. The move in fact is a 12% move, which is not what you expect regularly in a stock, but in this hypothetical case, to illustrate how these options behave, we deliberately chose a big move. So 12% in one day, there's no doubt that what you have to do is buy a very cheap call option which is very far out. It's like a lottery ticket. So what did we learn from this? The cheap options are great lotteries to gamble. They're very exciting. You make 12x return. I mean, where else do you get this kind of numbers, right? But I would not recommend this. I mean, if you want excitement in life, you should probably go to Vegas with $800, but this trade is not probably what you should do seeking excitement. We'll see why exactly I'm not saying this is not a great idea in the next slide. So in this case, we assume that the stock moved 12% in a single day. Let's just make things a little realistic, in the sense, instead of going 12% in a single day, this stock went, let's say, around 4% in a month. So that's like 415 in 30 days. So what happens if Tata Motors ended at 415 on expiry? Again, you can see the price of options on the day we start the trade. We'll calculate the prices of these options on expiry, which is Tata Motors 415. A 390 call made 25 bucks. A 400 call made 15. A 420 call made nothing because it's expiring below 420 at 415. A 440 call, 450 call and 460 call also made nothing. The profit from 390 call is 8 rupees, which is 25 minus 17. A 400 call gave you a profit of 3 rupees. 420, 440, 450, 460, they're all returning negative numbers as profit, so that's loss really. Now let's go back to calculating the return on investment on these options. A 390 call returns 47%. A 400 call returns 25%. Everything else gives you 100% loss because you have the premium paid for these options and you're losing the entire premium. So what do we know from this? All the higher strike calls which were less likely to make money went bust. Now this is exactly the flip side of lotteries. You don't often win lotteries. The lower strike calls are more likely to make money, and in this case they indeed made some money. They are very likely bets to take. The higher strikes of course are much more exciting. I mean, I have to admit that. I mean, think about the possibility of putting 1 rupee and making 12 rupees in its plates. So if you actually had, like, let's say 10k and you're making 12x return on a 10k, you're actually making a lakh and 20,000, which is very, very exciting. So what are the takeaways? The first takeaway is that cheap options, the higher strike calls in this case, are like a lottery. When they hit like crazy and give you a 10x return, but they don't hit usually. The second takeaway is of course that sellers most likely win and buyers most likely lose. So if you are a buyer, it's just safer for you to buy likely bets, that is the lower strike calls, at the money, slightly in the money and all of that. And if you're a seller, it's just safer to sell unlikely bets, give away a slightly OTM call or very OTM call. Now let's look at a real world example. Infosys is trading at 900. Here are some of the option prices of Infosys for the current month expiry. A 900 call is trading at 30. A 900 put is also trading at 30. This, by the way, is not a coincidence. There's a theoretical reason why the 900 call and the 900 put will be equally priced when the stock is at 900. We'll learn about that in later videos. For now, let's look at how exactly these things are going to make money. So when you sold a 900 call, you got a 30 rupee premium, which means that you're going to make a loss only if the stock goes up 30 rupees above the 900 mark. We are going to call this the break-even number. So the break-even number is the level of stock price at which you're going to make neither a loss nor a profit. So for the 900 call, the break-even number is at 930, which means anywhere below 930 you're not going to lose money and you're going to make some money. For the 900 put to break even, you have to recover the premium which you've already paid, which means the stock has to go down at least 30 rupees below the 900 mark, which means 870 is our break even number. For the 880 put, this number is 860. For the 860 put, where the premium is 15 rupees, this number is 845. And for the 840 put, which has a premium of 10 rupees, you have to recover this premium. So this number is 830 when the stock price goes below the strike price by 10 rupees. But since we are comparing the put with the call, the put has to not just break even, but it has to make more money than the call. Now we already know no matter how low Infi stock goes, the call will give us a fixed number, which is 30 rupees. So 30 rupees profit is the magic number we have to beat with the puts. Let's look at the 900 put. It breaks even at 870. So now we need another 30 rupees, which means 840 is the number at which this put performs better than the 900 call sell. In percentage terms, this is a fairly large number. In fact, it's over 6.5%, which is a fairly rare move given the market cap of Infosys. The 880 put breaks even at 860. Now we need another 30 for it to outperform the call, which is 830, that's 8%. The 860 put breaks even at 845. Now we need another 30 for it to outperform the sell call. This number is 815, which is 9% down move. The 840 put breaks even at 830. Now we need another 30 for it to outperform the call, which is 800. That is 11% move, which is very rare. So for all practical purposes, it is way better to sell the 900 call than buy a lower strike put. unless of course you know that a huge move is coming and the option comes to you at a very cheap number. Now, this happens towards the expiry when you can find this option for as cheap as 8 rupees, that is the 900 put. So I could summarize this as, to make money by selling a call, you just have to make sure that you're not very wrong. If you're anywhere in the slightly wrong or the right territory, you will make money by selling a call or selling any option in general. But to make money by buying an option, you have to be right and you have to be very right. And worst of all, you have to be right before the time runs out on expiry, which means you have to time the market also. Add these three things together, your odds of making money by buying options become very low. So let's summarize everything we have learned in this video. You buy options if and only if you expect immediate huge moves. Now both these parts are important. The moves have to be immediate because otherwise the time is going to run out on expiry, and the moves have to be fairly huge for you to recover the premium. Most of the time you're better off selling options. So every time you feel like buying a put, consider selling a call, and every time you feel like buying a call, consider selling a put instead. Of course, you can't blindly sell naked options. You have to do it with protection, which we'll talk about in upcoming videos. But in general, option sellers tend to make money, so it's better to stick to this strategy. When you do sell options, you have to be very careful about avoiding events. It's a terrible idea to sell calls or puts on single stock before a huge event in these stocks, like a results or an RBI policy or one of those things. Also, when you sell an option and you have realized that you're in the middle of a breakout, that is, the stock is going to trend one way in a huge manner against the direction in which you sold the option, you have to stop loss and get out immediately. That is our video about which option to choose and which strike to choose. Thank you very much for watching this.